If you ask most retail traders what their biggest disadvantage is, they might point to strategy, entry timing, indicators, account size, etc. However, those can be valid points, but they are not the real issue. The skill most traders skip, the one that determines whether an account survives its first year or not, is position sizing. Not what to trade, not which direction to take. The real risk lives in how much size you put on relative to your account, your stop loss, and the contract you're trading. And most traders never calculate it. They pick a number of contracts that feel reasonable, they place a stop somewhere on the chart, and they click buy. That is not structured decision making. That is not good decision making, period. If this sounds like you're trading exposure without control. In futures, every contract has a defined tick value. Every stop has a measurable distance. That means every trade has a precise dollar risk, whether you calculate it or not. If you do not calculate it, you are not managing risk. You're accepting it blindly. And over time, that is what breaks accounts. In this video, we're going to build position sizing from the ground up. What is it? Why it matters more than strategy? Where most traders get it wrong? And the exact framework we use at Lumeric to control risk trade by trade. This is one of the highest leverage concepts you can learn. And for most traders, this is one they discover only after they pay the market. Hi, I'm Wang, lead instructor at Lumeric Trading. We build structured futures education for independent traders who are serious about building a real process. Everything on this channel is grounded in the Lumeric curriculum and our coursebook, Day Trading Futures: A Practitioner's Guide for Independent Traders. Link in the description. Let's start with the definition. Position sizing is the process of deciding how many contracts to trade on a given setup based on three inputs: your account size, the maximum dollar amount you're willing to lose on that trade, aka your total risk, the distance from your entry to your stop, expressed in tick value, and that's it. The formula itself is simple. What makes it powerful is not complexity, it is consistency. Applying the same logic to every trade, every session with no exceptions. Because once your risk per trade is defined, position size stops being a guess. It becomes a calculation, and that changes everything. It means every trade carries a controlled known risk. It means no single trade can do outsized damage, and it means your results start to reflect your process, not randomness. In section 56 of chapter 11 in the coursebook, I break this down step by step with real life examples. That is where this concept really clicks, because you can see exactly how the numbers translate into real trade. Here, we're going to build the logic behind it so you understand not just how to calculate position size, but why is it the foundation of everything that comes after. Before we get into the mechanics, let's address why most traders skip this step. The honest answer is actually quite simple. They don't pay attention to the tick value of the contract they're trading. If I ask you right away what is the tick value for a standard NQ contract or the MNQ, could you answer immediately? Some can, and good for you, but many cannot. And that is the issue. Traders learn patterns, indicators, and setups before they understand the instrument itself. That approach itself is backward, because without that foundation, every trade you take is disconnected from the actual risk you're putting on. Here's what you need to know before placing a trade. The tick value of the contract, the number of ticks between your entry and your stop, your maximum risk per trade in dollars, your total account size, and that's it. Once you have those four inputs, position sizing becomes a calculation and not a guess. And once it becomes a calculation, your risk becomes control. Now let's walk through this with a concrete example and build it step by step. Tick value. The foundation, every futures contract moves a minimum increment called ticks, and each tick has a fixed dollar value. This is what determines your real risk. Not how many points the market moves, but how many ticks multiplied by the dollar value per tick. Let's make that clear with the main contracts. NQ, Nasdaq 100 futures. 1 tick equals $5, 4 ticks equal 1 point. 1 point equals to $20 per contract. Micro and Q, M and Q. 1 tick equals 50 cents, 1 point equals $2 per contract. ES, S&P 500 futures, 1 tick is $12.50, 4 ticks is 1 point, and 1 point is $50. Micro ES is exactly 1/10 of that. 1 point equals to $5 per contract. These numbers are important. Whatever contract you're trading, you should know its tick value without even thinking. Because every position you take, every stop you place, and every dollar you risk is built on this. If you do not know the tick value, you cannot calculate your real risk. And if you cannot calculate your real risk, you're not managing it. You're just guessing. This is why position sizing starts here. First, not with strategy, not with entries, with understanding exactly how price movement translate into dollars. Now let's put it together. Suppose you have a $25,000 account. A good rule is to risk no more than 1% of your entire account on any single trade. That means your maximum risk per trade is $250. Now you're looking at a trade on the micro and Q. Your entry is at a specific price level and your stop is 20 ticks below your entry. The question is, how many contracts can you trade? Step 1. Calculate the dollar risk per contract at $20 ticks. Micro NQ tick value is 50 cents. 20 ticks times 50 cents equals $10 risk per trade. Step 2. Divide your maximum risk per trade by the dollar risk per contract. In this case, it would be $250 divided by $10 equal 25 contracts. So on a trade with 20 tick stop on the micro NQ, a $25,000 account using a 1% risk rule can trade up to 25 micro NQ contracts. However, this does not mean you have to trade 25 contracts. You can trade up to 25 contracts depending on how confident you are with the setup. Now run the same calculation on a standard NQ contract. Tick value is $5, 20 ticks times $5 equal 100, risk per contract $250 divided by 100 equals 2.5 contracts, so you round down to 2. Same account, same stop distance, same risk rule, very different contract count, because the tick value of the instrument changes the math entirely. Now the framework is clear. Let's go through the 3 mistakes that show up most often. Mistake number 1, fixed contract sizing. This is trading the same number of contracts on every trade regardless of stop distance. If you're always trading 2 NQ contracts, a 40 tick stop risks twice as much as a 20 tick stop, whether you realize it or not. That means your risk is inconsistent, and inconsistent risk leads to inconsistent results. Risk should stay constant, which means position size must adjust based on your stop. Mistake number 2, ignoring account growth and drawdown. Position sizing should evolve with your account. If your account grows by 20% and your risk per trade stays the same, you're underutilizing your capital. If your account drops by 20% and your risk stays the same, you're increasing pressure on a smaller base. Both are structural errors. A consistent rule like raising a fixed percentage per trade keeps your exposure aligned with your account. Mistake number 3, over leveraging with micro contracts. Micro contracts are useful. They reduce per contract risk, but they can also create a false sense of safety. Trading 20 or 30 micro contracts without doing the math can result in more exposure than a few standard contracts. So the label micro does not mean low risk. Owning your position size relative to your stop and account defines risk. The risk framework in Lumeric position sizing sits inside the risk management pillar. The full framework is market dynamics, trade analysis, risk management, trading psychology, and this needs to be clear. Risk management is not something you add later. It is the foundation. A trader with an average strategy and strong risk control can survive and improve. On the other hand, a trader with a strong strategy and poor risk control will not last, because poor risk management leads to one outcome: account damage that cannot be recovered from. Lose 50% of an account and you need 100% to get back to even. That is not a strategy problem, that is a sizing problem. Futures trading carries real financial risk, and position sizing is not an advanced concept, it is a prerequisite. quick pause here. If you want to go deeper on the risk management frameworks I'm building through on this channel, I have put together a free guide called 7 Reasons Why Independent Traders Fail. Comment trading below and we will send it to you, no catch. Is one of the most important guides I have produced. Position sizing does not exist in isolation. It connects directly to the concept of reward-risk asymmetry, which is covered in chapter 3 of my book. Reward-risk asymmetry means structuring your trades so that your average winner is larger than your average loser. If you're risking $250 per trade, you should be targeting a minimum of $375 or $500 on the winning side. A reward-risk ratio of at least 1.5 to 1, preferably 2 to 1. Here's what that means in the context of position sizing. If you size positions correctly and maintain consistent reward to risk ratios, you can be profitable even if you lose more trades than you win. A trader who wins 45% of their trades at a 2 to 1 reward risk ratio is profitable over a large sample. A trader who wins 60% of their trades but take a 0.5 to 1 reward risk ratio, small winners, large losers, will eventually blow their account. Position sizing combined with reward risk asymmetry is the mechanical foundation of a sustainable trading process. Neither concept is glamorous, neither produces viral content, but they are the 2 skills that determine whether a trading account blows up over time or not. Here's a practical step you can take before your next session. Start with the contract you trade most often. Write down its take value. Know it without hesitation. Then define your maximum risk per trade as a percentage of your account. For most developing traders, 0.5% to 1% is a solid starting range. Now apply the process for every setup. Measure your stop distance in ticks, multiply that by the tick value that gives you your dollar risk per contract. Then calculate how many contracts fits within your defined risk. Do this before you enter the trade. Every time, make it part of your pre-trade routine, because once you do this consistently, you remove randomness from your risk. And here's something important. If you run the numbers and realize your position size feels too small to matter, that is not a problem. It is simply a feedback. It tells you one of 2 things. Your account size does not match the instrument you're trading, or your stop distances are too wide for the level of risk you're willing to take. These are structural issues, and they are far more important to solve than trying to find a better entry, because until size, risk, and structure are aligned, no strategy will perform the way you expect effectively. If this gave you a clear sense of what this channel is about, go ahead and like the video and subscribe. We post structured futures education every week, and each video builds on the last. If you're going to follow this, follow in sequence. Comment trading below and we'll send you the 7 Reasons Why Independent Traders Fail guide. It is free and is tied directly back to the 4 pillars we covered today. If you're ready to go beyond YouTube, the Lumeric Trading program walks through the full framework in depth. Market dynamics, trade analysis, risk management, and trading psychology. All structured and taught step by step. You will find the link in the description. And for those who want more of a personal touch and direct guidance, I offer limited one-to-one coaching sessions where we take a focused, in-depth look at your trading, your process, your decision, and where things need to improve. You can book that directly through the website or in the link below. Our official course book, Day Trading Futures, A Practitioner's Guide for Independent Traders, is also available on Amazon. It is the written version of everything we teach here. Even the preface alone will give you the right perspective before you go further. If you'd like to learn more about futures trading, click this video. You're one video closer to being a professional futures trader. Thanks for watching, and we'll see you in the next one.